Hello, everyone. Welcome to panel 5 of this AIMA Global Investor Forum 2021. I'm David Postlethwaite, Sustainable Finance Lead at Jersey Finance. As many of you will be aware, Jersey has emerged over recent decades as a leading and very stable specialist centre for alternative asset classes, with the net value of regulated funds administered in Jersey up 96% in the last 5 years. And Jersey Finance is proud to represent the finance industry in Jersey. And we do so by championing the competitive position of our 165 member firms, both at home here in Jersey and internationally, working with our partners in the government of Jersey, our financial regulator, international bodies and international gatekeepers to ensure that Jersey continues to provide attractive solutions to the needs of global investors. Now, in early 2021, we launched our own Jersey for Good strategy. This is a 10-year strategy for sustainable finance that recognizes the vital role that finance centers like Jersey and the investment community they serve will play in the transformation of sustainable finance from niche to mainstream. And in my current role, I help to put that sustainable finance strategy into action. So it's always a privilege to engage with industry experts like the people on our panel today, people who are on the front line in terms of driving the integration of ESG into the alternative investment space. Now, the topic for our discussion today is Protect and Enhance, the rise of ESG and sustainable finance, which I think we agreed when preparing this session is a very broad topic and one which could no doubt generate a much longer discussion. But we'll try and focus in on a few key themes of interest today. And if time permits, we may even attempt to tackle an audience question or two. So to help us explore those themes, I'm delighted to be joined by our expert panel for this session. We have Catherine Simard. Catherine's role is as Director of Stewardship Investment at Caisse de dépôt et placement du Québec, a large institutional investor managing several public and parapublic pension and insurance plans in Quebec. We also have Rita Mangalik. Now, Rita is Managing Director and Global Head of ESG for Hedge Fund Solutions at Blackstone Credit, where she partners with both groups and leads various initiatives around ESG diligence, reporting and engagement. And we also have Chris Addy. Chris is the founder and CEO of Castle Hall, a leading specialist in operational due diligence for alternative and traditional asset managers. So panel, welcome. Perhaps before we get into it, I could invite you all to just say a few words about yourselves and make some opening remarks on our topic today to really give the audience a better sense of where we're all coming at this discussion from. Catherine, would you like to start us off?
Yes, sure. Thank you, David. And hello to all. CDPQ is a Canadian pension fund with approximately 400 billion in assets. We have assets in all major markets, North America, Europe, Asia Pacific. We invest in equity markets, private equity, fixed income, real estate, and we have a sustainable approach to investing. We incorporate ESG decisions into ESG considerations into every investment decision. I really love the title of the panel today, Protect and Enhance. ESG to protect has been top of mind for quite some time. ESG started as a risk mitigation tool, really part of our investment due diligence, part of our defensive strategy. But ESG to enhance, to generate greater returns is also becoming a really integral part of our offensive strategy. So we're reflecting on ways to think about our ESG, in our offensive strategy. And we are thinking about how we can make sure that our portfolios are best positioned to face a transition to a more sustainable economy. We think that this transition will accelerate, that some companies will position themselves better than others. And we're also thinking about ways to better support our portfolio companies in the adoption of ESG best practices and to generate value. So protect and enhance, in my view, are two words that sum up quite well what ESG is all about.
Oh, that's great. Thanks for that. Rita, can I come to you next?
Sure. Thank you, David. So as background, I've been with Blackstone since 2013, started within BAM, our hedge fund solutions group, and led the implementation of its ESG program. And I'm also now leading Blackstone Credit's ESG efforts. So completely agree with Catherine. Protect and enhancement and enhance is a really great title for this panel. So within BAM, we invest in hedge funds across various strategies, so including long-short equity, credit, quant, macro, emerging markets. And we are seeing our hedge fund managers continue to evolve and progress on their approach to ESG, and we would like to be a resource for our managers to share information we are seeing to continue to move the industry forward. And on the Blackstone Credit side, we're also doing something very similar where we're integrating ESG as part of our investment process and continuing to enhance and evolve and progress our initiatives.
Great, thanks. And finally, last but not least, Chris, can you introduce yourself?
Sure. So I lead Castle Hall Diligence. We work with 150 investors worldwide to support their due diligence programs. Traditionally, our world has been an operational due diligence, but we started actually about 5 years ago, starting to think about ESG, recognizing the fundamental redirection and evolution of all aspects of our industry and the investment process. We have completed operational due diligence on, I think our current list is about 1,200 asset managers across the industry, across all asset classes, but with a focus on alternatives. ESG is catching up. We have about 150 due diligences completed on the ESG side of things, and we're really seeing a strong movement of investors looking to now integrate a more formal and structured ESG due diligence process into their own investment workflows. I think one thing I would say here is that, particularly for asset managers, it's very important for us all to work collaboratively and constructively. We try very hard to be recognize that there isn't a right or a wrong answer. This is a journey rather than a simple solution. And certainly from a due diligence perspective, we are not approaching asset managers with a view of guilty until proven innocent. So we don't assume that managers are all greenwashing until we can prove the other way around. This really is a more nuanced and evolving discussion between investors and managers looking for mutually beneficial enhanced solutions over time.
Great, thanks, Chris. So, okay, let's get into it. So let's move on from those introductory remarks and turn to the first theme that we identified for today, which is around ESG integration. And we'll start off by thinking about hedge funds in particular. And we know there is a perception in some quarters that hedge funds don't always rhyme with ESG. We also know that, just as you said, Chris, like other sectors, the hedge fund industry is on a journey when it comes to sustainable finance. But Rita, if I can I come to you first? Would you start by telling us, what does good ESG integration look like in a hedge fund setting from your experience?
Sure. So we always tell our hedge funds that there's no one size fits all approach to ESG. In order to achieve success, you really need to develop a policy that is appropriate and makes sense for your strategy. So one of the first things that we recommend doing is, identifying why you believe ESG integration is important. Are you implementing ESG for risk mitigation or performance enhancement, or both? And then once you've made that decision, establish what commitments you're going to make. If you're committing to consider ESG factors for every new investment, how are you ensuring that you have the framework and data to do this? And then it's also important to create accountability. You may want it to include a steering committee that includes ESG champions from different teams across the firm. Here you can discuss ESG initiatives and related progress. We've done that within BAM and we've done that within Blackstone Credit, and find it very useful to have everyone sit around the table and discuss, what they're working on, what they're hearing from the marketplace, from LPs, and, making sure that we're progressing and moving forward. And then also identifying ESG resources. You have to, make sure that you can actually, you have the tools to identify what material ESG risks are. So using rating providers like MSCI or Sustainalytics, or an ESG framework like SASB. AMA also has great ESG resources, so taking advantage of these if you haven't already.
Thanks, Rita. Chris, coming to you next. From your vantage point, you obviously talked about due diligence. Can you dig into that a little bit? What role can due diligence play in supporting better ESG integration? Perhaps not just at the manager level, but also, as I think we referred to previously, in the supply chain.
Mm-hmm. Sure. When Castle Hall completes due diligence on behalf of our clients, we're actually looking at two different levels. So first of all, the asset management company itself. So who has the institutional investor hired to manage money on their behalf? So the asset manager, a hedge fund, is essentially a vendor to the institutional investor. And then we're looking at the investment decision-making process. So how does that hedge fund or other asset management company integrate ESG considerations into their investment decision-making process? And we call that, on the one hand, the responsible investment manager, and on the other hand, the responsible investment strategy. When we first started looking at ESG, again, about 5 years ago, it was a very early stage evolving landscape. There was already the alphabet soup of all of the different acronyms and frameworks, and then there always seems to be another one coming up. And a lot of the information, in fact, pretty much all the information, was manager self-reported. So obviously the PRI is a central repository of data. But ultimately, that is information coming from the asset manager without verification or validation. And of course, as many of us know, there are some hiccups at the moment with the PRI and the postponement of reporting due to the difficulties with the new reporting framework. So we have a bit of a gap there. Ultimately, from Castle Hall, we're a due diligence firm, and due diligence is always the same, irrespective of what area we're looking at, which really is three things. So first of all, what are the policies, procedures, and controls in place? So as a hedge fund, what are you doing? Very much to pick up on Rita's earlier point. Secondly, do those controls, policies, and procedures operate as described? And that is where we're actually looking for some evidence, some proof, some discussion, some ability to actually see the workflow that's in place. So if you are a hedge fund manager or another active in another sector, if you say you have an ESG policy, have a document. This is not rocket science, but have a document that is available to your investors. Make sure that that document isn't a page and a half of generic information. It is actually a thoughtful, adequately detailed policy document which is applicable and tailored to your investment process and your organization. If you say you update the ESG policy every year, don't give me a document that's dated June 2018, because that's more than 12 months. And I think that's one of the key areas of difference, to move beyond general statement and generic narrative description to a much more structured and evidence-based ability to say what you do and prove that you do what you say. And I think, as a final comment, we're very keen to be able to work with our investor clients, as well as the asset managers that we complete due diligence on their behalf, really to gather data. And I think one of the other difficulties in ESG has been the fact that as it's been early, a lot of the diligence process and questions and questionnaires, etc., have been well-intentioned, but very open-ended questions that invite narrative responses. And that's certainly helpful, but ultimately it's not comparable. And as this grows up and becomes more institutional, I think the more data that we have and the more that empowers investors to deliver insights across their portfolio is very helpful. So, for example, what percentage of my managers do operate from LEED certified buildings? What percentage of my managers have engaged in training for those involved in recruitment to avoid unconscious bias? What percentage of my managers have adopted negative screens around certain different economic areas, etc.? So it's coming back to make things more tangible, more evidence, more structured.
Thanks, Chris, for those insights. A couple of words I've picked up on in both what you said, Chris, and what Rita said. We talked about accountability and we talked about controls, which all sort of points to the role of governance, really. And I know, Catherine, this is an area that is of interest to you. I know that the PRI guidance for ESG incorporation points to the the importance of governance as one of the sort of key modules of a responsible investment approach. Can you tell us a little bit about the role of good governance and how perhaps ESG is reframing expectations in terms of governance in the alternative fund space?
Absolutely. I would argue that it all started with good governance. Governance at CDPQ is the historical pillar of our strategy. We always had a strong focus on governance. The first head of our department was a lawyer. She was also the head of ethics and compliance. Our work started initially in equity markets with a strong focus on proxy voting, on engagement, on mainly topics related to governance issues. Things have evolved since then, but for us, governance is still a first line of defense because we believe that a strong, independent, diverse board is really essential to the long-term success of our portfolio companies. Boards have a duty of oversight, and this requires, among other things, at least a basic understanding of environmental and social issues and their impact on a company's risk profile, competitiveness, resilience. So it's still very important. And cybersecurity and technological resilience is also part of our governance pillar. So we'll continue to make sure that the governance practices of our portfolio companies are appropriate. But what I think is quite interesting in governance these days is the governance of ESG within your own organizations. ESG has been growing in importance really quickly. In this context, making a few tweaks and reflecting on your own governance of ESG is particularly useful. And we have been reflecting on this over the last year. Things like how can we strengthen our influence on portfolio companies and managers to create value using ESG? How can we capitalize on our designated directors to put forward our conviction on ESG on their boards? And how can we ensure that our investment committees really have all the information they need to take into account ESG risks and opportunities when they make investment decisions? So we're optimizing our own governance to reflect the fact that ESG is really now a cross-cutting team, and we need the whole organization to be involved, to be on board. Yes, so coming back to the title of our panel, yes, we want ESG. We still want ESG to protect. We want to continue integrating ESG into our risks analysis, but we also want to focus on ESG to enhance. We want to mobilize our investment teams so that they can reflect on how ESG can be an offensive tool to generate greater returns. And for us, this governance starts with a strong tone at the top. So a strong tone at the top from our board, from our CEO, and the rest of our executive team.
I think that's something that will have a lot of resonance for our members here in Jersey. Moving beyond the concept of sustainable finance and ESG as purely, as you say, a way of overhauling your investment decisions or the way you manage risk, but also looking at it in terms of building it into the culture of the organization of the financial services firm itself, and as you say, setting the tone from the top. Any further thoughts from Chris or Rita before we move on to the next of our themes on that subject of governance?
I just wanted to add the strong tone at the top is so important. I think when you have an organization, if the CIO, the CEO are supportive of ESG, that is, the only way that it actually works. Because ESG is not a one-person job, right? It really has to be accepted and organized across the entire organization.
Yeah.
I think from my side, one of the key elements of ultimately is ESG meaningful and impactful on the organization, either for an asset owner or an asset manager, is ultimately how are people paid? And there isn't a magic formula of this is the most simple way to integrate a percentage of compensation to different levels of the organization, different functional responsibilities. But ultimately, if ESG doesn't impact pay, it is relatively difficult to see how that is truly going to influence behaviors and really is reflective of an organization that is saying that environmental social governance factors are central to the mission and direction of the organization going forward. It's one of the most interesting statistics that we have when we do diligence on underlying managers. Have you changed your pay and compensation policies to take account of ESG for investment professionals, for example?
That's helpful. Thank you, Chris. The next of the themes that we'd identified for today it takes us off in a slightly different direction, and perhaps back into the nuts and bolts of investing, I guess. So if we can move the discussion on to the second theme, which bears the working title, engage or divest. So in terms of protecting and enhancing investment, but also, I guess, in terms of ensuring that we're delivering sustainable outcomes, is it better to engage or divest, and how do you solve that dilemma? So Catherine, I'll come to you first, if that's okay. Tell us about the approach at CDPQ. How are you balancing engagement, stewardship with divestments?
Engagement is really an integral part of our ESG strategy. We engage our portfolio companies, our external managers on ESG factors. We also use our influence as board members to enhance ESG at the level of our portfolio companies. We encourage companies to adopt best practices to enhance their ESG disclosure. It's also a really good opportunity for us to discuss with the board certain issues that were raised in our ESG analysis. What we found is that collaboration with other investors is really efficient. We have been participating in initiatives such as the Climate Action 100 Plus. This has been a good way to influence the practices of the largest emitters. So when done right, engagement is a really powerful tool, especially for long-term investors. And we think that we can generate positive change when we remain at the table. So we will usually favor engagement over divestment. However, in the last 2 years, we announced that we would divest from certain sectors. And the main reason is that these sectors are not really compatible with our long-term approach to investing. So last year, we signed the tobacco-free finance pledge, and we officially withdrew from the tobacco industry. And also with other members of the Net Zero Alliance, we also pledged that we would no longer finance any new thermal coal projects. And we agreed to gradually phase out all coal-powered assets. And just a few days ago, we announced that we would complete our exit from oil production by the end of 2022. So in conclusion, my view is that it's not necessarily an either or choice between engagement and divestment. The two can work quite well and be part of our strategy.
Thanks, Catherine. Now, Chris, when we were preparing this session, you made an interesting point, I think, about the potential for conflict between the different components of ESG. So does divestment as a strategy or the deflection of investment away from certain legacy industries highlight that potential for conflict, particularly in relation to the E and the S? And can you expand on that point a little more?
Sure. I think it's a fascinating time for both investors and managers, and ultimately there is not a simple answer to a complex question. I attended a webinar prepared by EDEC, the French business school, recently, and they had done some research that said that essentially if you included social factors in your stock selection process, that potentially resulted in a less favorable environmental outcome. So for example, if you look at a social issue such as labor relations, that may mean that you have more companies or a higher weighting of companies in the portfolio which have better labor relations, health and safety, unionization, modern slavery, a variety of criteria there, but perhaps they are not quite as strong environmentally, or equally perhaps environmentally strong companies are slightly less good, however good may be defined, when it comes to some of the S characteristics. And I think there are a great deal of contradictions and potential topics that can come up. So, for example, 2 points would be the interest, for example, in multi-family residential housing. That's a very, very popular strategy for institutional investors at the moment, something we see a lot of here in Canada. But there is obviously a lot of criticism that this strategy is essentially about renovictions, whereby you adopt a range of renovations in an apartment building to increase the rent, and that therefore makes the apartment no longer available for lower income citizens who can't afford it. Another one would be, get everybody's attention, would be cannabis. Cannabis is, of course, now legal here in Canada. From a pure screening perspective, the obvious sin stocks were always alcohol, gambling, tobacco, pornography. Easy to add cannabis to that list. Yet there is, of course, a social justice argument that cannabis is something that has disproportionately impacted marginalized and racialized communities with respect to incarceration, police action, etc. So I think for an investment manager, really, the first rule of due diligence is don't be surprised. So what do you own in your portfolio, and have you thought through the potential implications of those stocks, their activities, their activities in different markets, different subsidiaries? And are you really able to monitor and evaluate what those portfolio holdings are doing, and be able to describe and evidence a thoughtful investment process whereby some of those trade-offs and some of those balances evidence that, yes, we have thought about, and this is how the portfolio has been constructed.
And I guess tools like being able to map against the SDGs might be quite useful in seeing how those different potentially competing aspects overlap. But Rita, we said that we come to you next because I wanted us to just ask for your actual practical experience. What are the challenges or barriers that you face when trying to build engagement on ESG? How does that work in practice?
Sure. So I think engagement is definitely more difficult when you don't have significant influence over a company. So if you don't have majority ownership or a board seat, it's more difficult to have engagement, but it's not impossible, right? So I think a lot of we are seeing more abilities to engage, which is great. So a lot of our hedge funds are engaging by proxy voting, which is kind of standard across the industry. And there are options where you can now engage a third-party firm to vote in a sustainable way based on various criteria, which I think is, definitely a step in the right direction. And then we're also seeing more funds have soft engagement with companies where you may not have a board seat, but you can still engage with the ESG group within a company. And we're seeing, a lot of companies have smaller ESG teams internally, and they really want to hear about what we think in terms of, what their ESG roadmap should look like, suggestions that we may have on how they can enhance their internal practices. So I do think that there'll be more and more of this over time as we're seeing more firms, more companies declare net zero commitments, and we're hopeful that we'll be able to be a resource for these companies as well.
And can you tell me, Rita, when we talk about engagement, it feels like sort of engaging down the investment chain, but is there much engagement outside with external stakeholders and so on? How does that process work for you?
So we're continually engaging with our LPs, if that's what you're referring to. We also have, within BAM, we've done ESG manager roundtables. We'll actually have our managers across different strategies come in and talk about how they're implementing ESG hurdles that they're facing. We've seen that be really helpful because then people have a forum to share their ideas and concerns. We've also had, an ESG consultant come in and speak to our managers about how they should be thinking through ESG as it makes sense for their business. we've held ESG seminars with companies where we've had senior level professionals at Blackstone essentially kind of speak to hedge fund managers, because no one has perfected this, right? So we're kind of talking about the journeys that we've seen internally and kind of the approach we've taken, and discussing that with our partners, just to essentially move everyone forward.
Great, thanks for that. So if it's okay, I'd like to move us on to another discussion theme that we'd identified for today, which is to explore how we can balance the demands of diverse stakeholders when it comes to ESG. So in thinking about this final theme, I'd like us to consider, how do asset managers respond to the challenges of ESG integration when different geographies perhaps present different challenges in terms of, say, investor expectations, approaches to fiduciary duty, regulatory environments. And so we're seeing asset owners in the UK, for instance, coming under new requirements to adopt TCFD recommendations. That's perhaps a bit further down the road to some other jurisdictions. So, Chris, to kick us off, what's your take on this?
I think it's a real moving target, and as an asset manager, really it is just the practical question of keeping aware of the business environment, what is happening in different jurisdictions where you either invest or have investors. Ultimately, you can't keep all of the people happy all of the time. So to be able to say, well, what is the target and focus of my efforts to raise capital and source capital, and obviously where am I investing my portfolio, but clearly the expectations of investors coming from continental Europe are likely different than coming from the US. And we have regulated and unregulated investors. One of the strongest ESG committed clients that Castle Hall has is a very private family office, which is undergoing a generational transition. And actually, as the younger generation come into that organization, they are probably one of the most committed clients that we have to be focused on ESG and underlying portfolios, and they are not regulated and are not directly subject to the new European rules, to the PRI, to Department of Labour, to any of the different structures. So it's I think for asset managers, it's really on the investor side, understand your clients. What are the client's profile? And where are they coming from, and consequently, what are some of the legal and regulatory current frameworks and proposed frameworks that could be implemented in the near to medium term?
Rita, I'm sure you have a view on this as well. What do you think about the balancing of different stakeholder requirements? Rita, you're on mute, sorry.
That's just embarrassing. I can't believe I did that.
Don't worry.
All this experience. So I think, a year or two ago, I really feel like there was a difference between what US LPs expected versus European and versus Asia LPs expected from an ESG perspective. But I would say now the LPs really expect ESG to be considered as part of the investment process, whether the fund is based in the US, Europe, or Asia. So, I think Europe is definitely leading the way with regulatory initiatives to address ESG. However, sustainability is important to everyone. But with EU regulators focusing on greenwashing and improving transparency for investors when it comes to responsible investing, the adoption of SFDR coming into effect as of March 10th, 2021, we're definitely seeing more and more questions on, how our funds are categorized under SFDR. And we're in the process of understanding the regulatory reporting requirements depending upon what the fund is classified as. So I think EU is the first to make the move from a regulatory perspective, but I'm pretty sure the US will follow shortly. And we really manage our funds and our approach globally. So we work with local teams and advisors to monitor new developments, regulations, but we really have a global approach to managing our funds.
So whilst you mentioned the United States, perhaps for a non-US audience and people like myself, can you give me a sense of what the market feeling is around the likely direction of travel regarding ESG in the US? We've seen consultations by the SEC. We've seen them kind of flexing their muscles around greenwashing. What's the direction of travel there, do you think, Rita?
Well, it seems to me that there'll be more disclosures required from US companies based on their climate risk, their physical and transitional risk. So I do think that, from my perspective, if those disclosures came to fruition, it would just provide more transparency to investors. So we'll see. But I think there'll be a lot to come in the next couple of years.
And Catherine, if I could just come to you for a view on this, with SFDR in Europe, the UK potentially taking a slightly different approach, the US potentially taking a different approach, is that a challenge to manage those divergent approaches, or is there actually some degree of convergence that's starting to filter through, or is that perhaps something for our leaders at COP26 to consider?
Well, I hope there will be some convergence on these topics. For a global investor like CDQ, it's really important that there is a certain that all the jurisdictions have the similar requirements, because it can get quite confusing. I know that all the major Canadian pension funds have announced that they are supportive of TCFD for climate and of SASB for other material ESG factors. And so hopefully other jurisdictions will follow suit and will be able to compare apples with apples and have appropriate and consistent disclosure from our portfolio companies and external managers.
And Chris, any final thoughts on whether that will make the process of due diligence any easier if we are comparing apples with apples?
I think the first point is always transparency. The more transparency we have, the better. Convergence of regulatory reporting. Again, I'm originally an accountant for my sins, so having more standardized GAAP obviously supports comparability of financial reporting across markets. I do think there are a fair number of bureaucrats who are enjoying a little bit of empire building in each different jurisdiction, so that it may take a little bit longer. Ultimately, from a diligence perspective, I'll come back to one of my earlier comments, which really is about data. Again, something like the TCFD, there are a lot of open-ended questions in the TCFD framework. How ultimately do I pull that together and really come up with something which is tangible and a discrete data point that allows comparability? So the more that we have data structure rather than statements of good intent, I think that's certainly something that moves the diligence process forward.
And do you think there's a need for kind of upskilling generally within industry? What we're hearing here in Jersey in terms of being able to support the integration of ESG reporting is that there is a real lack of skills within industry generally. And of course, what we do here in Jersey is provide the servicing, the architecture for many of these fund structures. Is that something that's present across all your jurisdictions as well? Catherine, for instance, in Canada, do you find it difficult to get the skills on TCFD?
Yes, and actually what we've been focusing on in Quebec, at least, and in Canada, is training students on sustainable finance. And we now have new programs in place to make sure that we have new blood coming, and we can ensure that in the future finance degrees will include sustainability considerations.
Great. Rita, can I come to you for any final thoughts before we wrap the session up today?
One thing on climate too is that we've we recognize that we don't have, every type of expertise internally. So we're also, leveraging ESG consultants who are focused on the environment, and leveraging their expertise. And we found that helpful as well.
Great. Well, thanks, everyone. I'm mindful that we need to wrap the session up today, and I think that brings us nicely to a close as we've reached the end of our allocated time. So I would like to close the session today by thanking all our panel members, Catherine, Rita, Chris. Thank you very much for generously sharing your time with us and your insights today. I'd also like to thank the team at AIMA for the opportunity to moderate this panel and for all the hard work that went into organizing the event. And finally, of course, thank you to the audience for joining us. I hope you've enjoyed today's discussion, and goodbye for now, and I'll hand back.